Now let's look at the exchange rate policies. The most common policy is the clean or free float or flexible policy, meaning that the country, the central bank of the country would allow its currency to float freely and and let the market decide where the exchange rate would be. However, um, although we call this free float, it's not exactly free because at the very extreme market market performance, then the central bank will have no choice but to come in to restore some sense of order in the market. Or if the currency has become too strong or too weak, then when it hurt the interest of the country, that country will step in. A very good example of this would be the US dollar. A lot of people think that the US dollar is a good example of the clean or free float or flexible policy. But we have seen in the past when the United States, through the Treasury Secretary, do come out and make statement and do try to change the market's trend or the market's movement for the US dollar. The most famous one is the Plaza Accord in 1985. That's when the US dollar had been so strong for quite a long time that it had been hurting the US export. So Treasury Secretary Baker invited the finance minister from the major countries to United States and held a meeting at the Plaza Hotel and told them that they have to help the US to intervene in the market to weaken the dollar, strengthen the yen, strengthen the Deutschmark, and so on. So that began a huge movement in the global market where the yen strengthened so much that the Japanese economy changed its structure and outsourced a lot of the factories into the Asian market and created the Asian tigers. When they when they opened up factories in Malaysia, Thailand, and so on. And then a few years later, when Treasury Secretary Rubin came out and keep saying a strong dollar is in the best of America's interest. A strong dollar is good for America. And that coincide with a turnaround in the global market that strengthened the dollar significantly and created a lot of difficulty for the Asian countries that borrowed in US dollar. And that subsequently led to the Asian financial crisis. The second common method of exchange rate policy is called the dirty or managed float or target foreign exchange rate, or more commonly known as the crawling peg. The Singapore dollar is a very good example. Here you see on this diagram here, the Singapore dollar NEER, the nominal effective exchange rate. So it did not manage directly by looking at the Singapore dollar compared to the US dollar. They look at the Singapore dollar on a trade weighted basket. And this trade weighted basket is calculated using the nominal effective exchange rate. Obviously, if they have to intervene, they would not intervene against a trade basket. They will intervene against the US dollar. So you can see from this chart here, the MAS, the Central Bank of Singapore, the Monetary Authority of Singapore, they set the band, the, the crawling peg. And at this point here, the MAS would intervene to buy US dollar and sell the Singapore dollar. Just like over here, they would have done the opposite. They will be selling US dollar, buying Singapore dollar. Now notice that this peg, or rather this band, right, uh, can be changed. The MAS have been known to expand the band during time when the market is very chaotic. And when it's very chaotic, they let the market more room to move before they step in to intervene. This is a good compromise instead of allowing their currency to be free floating and only step in at very extreme situation and create very extreme repercussion in the market, or stick with a peg with a very, very tight band where they have to intervene almost constantly. A crawling band would give them a compromise where they do not have to intervene too much, but yet have a manage a targeted range of exchange rate where they think is optimal for the country. So, having mentioned the peg currency, the peg policy, we move to the third policy. The peg of fixed rate policy is very well exemplified by the Hong Kong dollar. So in this peg version, what we're looking at is a very, very narrow band, very, very narrow band. And you can see from this axis here, we're looking at like a very little amount of flexibility. At this level here, when the Hong Kong dollar is too weak, the HKMA, the Hong Kong Monetary Authority, which is a central bank, which is a de facto central bank of Hong Kong, will step in to buy Hong Kong dollar to prevent it from getting too weak. When they buy Hong Kong dollar, they have to sell US dollar. And then within a short period, over here, when the Hong Kong dollar is too strong, the HKMA would then sell Hong Kong dollar and buy US dollar. Why is the Hong Kong dollar pegged to the US dollar? Well, the answer is that so long as the GDP of Hong Kong is very close to the GDP of the United States, the peg makes a lot of sense. If you were to go to this website, Trading Economics, and draw these two lines, the US GDP growth rate and the Hong Kong GDP growth rate, you will see that they do somewhat move together. And this is important because if the US economy is too strong, then we would expect the Fed to raise rate. If the Fed raise rate, then the HKMA would also have to raise rate. Otherwise, money would flow out of Hong Kong into United States. And this would give a lot of stress to the peg. So long as the Hong Kong economy follow the US economy closely, then it is okay for the HKMA to peg the Hong Kong dollar to the US dollar. At some point in the future, will this change? At some point in the future, will the Hong Kong economy move in a more correlated manner with the Chinese economy and less with the US economy? Well, when that happens, then the HKMA would have to rethink about shifting the peg away from the US dollar to the Chinese currency, the renminbi. There are a lot of countries that have a peg policy, and they're typically small countries. And most of these small countries, when they have a peg, they would also have a currency board. Hong Kong has a currency board. What is the role of the currency board? Well, the idea here is that these countries are very small and they want to assure foreign investors that they have a sound currency policy, meaning that they set up a set of rules for themselves that they would not simply print their money. Well, then you say, doesn't that sound like the gold standard? Well, yes, this is a modified version of the gold standard. Their currency board is forced in a manner where they can only print every new note when they have gold or foreign currency, hard foreign currency in their fund. Right? So the currency board of Hong Kong will only are allowed to print one new Hong Kong dollar, right, that correspond with the availability of gold or US dollar or euro in the currency board. Okay? So this prevent the overprinting of Hong Kong dollar. Well, the trouble with a pegged currency is that the central bank have to intervene very, very often. Sometimes sell dollars, sometimes buy dollars, as we have seen in the example just now. And when they intervene too much, when they are selling dollars, they are running down their reserve of US dollar. Right? So you can imagine, right, when a country intervenes too much and the market realize that their amount of US dollar reserve is falling, then the market will speculate that at some point the central bank would have to give up and allow the peg to be devalued to a weaker level. So in this example here, you can see that we had this very significant amount of foreign exchange reserve drawdown, where the Saudi Arabia monetary authority have to defend the riyal, and when they buy back the Saudi riyal, they have to sell US dollar. So the market will betting that perhaps the peg would be devalued. When we talk about a peg policy, one would want to bring in the euro. And when we look at the euro on the map of Europe, we see a very, very confusing situation. In this diagram here, you see the dark blue, right? These are the euro area, meaning that these countries do not have their own currency anymore. They have adopted the euro as their currency. Then we have the light blue countries that have their own currency but pegged to the dollar. The most famous one, right, is Britain, Sweden, Poland. They have their own currency, but it's pegged to the euro. And then we also have the floating currency. We have the Danish krona, and we have the Bulgarian lev. Right? But in this class here, I want to focus more on the euro itself. There's countries in the euro area that share the same currency. In a way, there's a pact, right? This is a pact because the German currency, the euro, is pegged to the French euro, right? And even though they're different countries, they're sharing the same currency. Right? There is a pact here. When we think about foreign exchange movement, and we ask what is the main driver that create movement in the foreign exchange market, the answer is very simple: supply and demand. And what is behind supply and demand? The main factor would be relative economic growth. If country A is growing stronger than country B, we would expect money to move out of country B to country A in search of greater opportunity. In that case, the currency of country A will be stronger and the currency of country B will be weaker. Having said this, is it realistic to expect that Germany and Portugal to have similar growth rate? If not, then wouldn't money move if Germany has a pattern of stronger growth over time and Portugal has weaker growth, wouldn't one expect money to move out of Portugal into Germany? The answer is yes, right? And this is where there's a tension within the euro area system. And the tension is they share the same currency, the euro. But when there's relative growth rate, then we would expect money to move out of the weaker part of the euro area into the stronger part of the euro area. So this is a risk of a pegged currency. And when the pegs are broken, as you can see on this diagram here, Egypt, the Egyptian pound incurred the worst first day loss among the countries that have given up the peg. And how much did they lose on the first day of change? 45%, right? 45%. That's huge. Right? So now back to the euro. Can we observe the tension? Can we try to predict when the peg will change? Well, to understand this, we have to ask this question. When a country joined the Eurozone, what happened to its macroeconomic policy? Clearly, Portugal, Italy, Spain, they have to give up monetary policy and currency policy because it will be the ECB that will decide on where the euro interest rate should be. It's the ECB that will decide whether the euro is too strong or too weak. So what each of these member countries have left with is fiscal policy, meaning that when the economy is weak, they have to borrow to spend more to support their economy. And when times are good, will they repay the debt? Well, so far what we have seen is no. So far what we have seen is they still borrow, but not as much as when times are bad. The government spending, right, in some of these weaker countries have tend to be greater than the tax that they've collected. And when that happens, they have to issue government bonds. and hope that the ECB will buy the bond, or they will have to borrow euros from the other European countries. The target 2 balance is a very good way to track this tension. As you can see from this chart here, Italy, Spain, and even the ECB has been borrowing money from the system. And who has been lending the most money? Germany. So if you look at the trend, right, one have to ask, okay, at what point would the Italian and the Spanish people say that they have been borrowing way too much money? Or at what point would the Germans say they are lending way too much money to the system? So over these years, what we have seen is as Italy continue to borrow, and even though the ECB have suppressed interest rate down significantly, you can see from this chart that the interest payment for Italy is extremely high. Okay. And if you look at the situation in Greece, you see that the good news is from the general government budget balance, there was a huge deficit and it stabilizes. And in terms of their 10-year government bond spread over the German bund, it has come down dramatically. So good news here, good news here. But when we look at the GDP number, especially the fixed investment, we have seen no improvement. In fact, one would say that things have gotten worse. And look at the Greek banks' gross non performing loans. The percentage of exposure is about 40%. It's very bad, right? So, so when we observe peg currency, when we observe the euro, we need to pay attention to the relative growth rate, and we have to watch when this peg cannot be sustained. This concludes this segment.